Fixed income has come into its own since the crash of 2008. While a lot of people buy ETFs or exchange-traded funds for equities, it may not be known that they're just as strong as fixed income. Today, we have Heather Pelant, the director of BlackRock iShares Canada division, to explain the differences. Thanks, Heather.
Thank you.
Now, let's say, for the benefit of those who aren't sure, just tell us what even an equity ETF is.
Yeah, it's interesting. It's the fastest growing investment trend in Canada, growing at well over 20 to 25% a year. But most people are unaware of this new vehicle that's kind of exploded onto the scene. And really what it is, it's a hybrid of two well-known vehicles. So on the one hand, it's an index fund, and the other hand, it's a stock. So it does bring the best characteristics of those two together. And with the dawn and emergence of fixed income ETFs, it's just opened up a whole new avenue of efficiency and precision for Canadians as they think about constructing a fixed income portfolio.
And since the crash, in fact, are people flocking to bond ETFs?
Yeah. I would say that the last 2 years have been the era of fixed income ETFs in Canada. And, last year we were number one. The iShares fixed income suite was number one by a wide margin as people stepped into corporate bonds. They stepped into real return bonds. They wanted short duration governments and long durations. So absolutely, I think it's become a really nice alternative to either an individual bond or a bond mutual fund. Fixed income ETFs offer a lot of really sound characteristics.
Now, I know in the mutual fund world, people often criticize bond mutual funds, not just because of their fees, but just the very fact that they don't mature in a way that a single bond does. And with interest rates headed only up, is there not even an equal risk in bond or fixed income ETFs for the investor right now?
It really gets to how you think about construction of a fixed income portfolio and try to understand duration. I think that's one of those things that now that you have options, you can go short or you can go longer term. It's allowing people to make that same risk and return trade-off they would with their stocks with fixed income. And the maturing capacity, you can absolutely buy what almost looks like an internal ladder within a fixed income ETFs. And in fact, we just launched 2 U.S. options on the Toronto Stock Exchange. As we heard very loud and clear from clients, it said, I've got a lot of good Canadian options. Now give me some international options for fixed income.
So these are U.S. corporate bond funds?
Correct. There's a investment grade and as well as a high yield, both hedged back to the Canadian dollar, that we launched about a month ago. And again, particularly in the area of high yield, as investors and boomers are starting to age, they're looking for what are my good caliber yield options. And so again, this is another way that we're able to, in Canadian dollars, give Canadians exposure to the U.S. fixed income market.
Now, the high yield one is investment grade. Was it under triple B or something like that?
That's on the high yield side, exactly. And as well, when you compare that with the investment grade, and then people can make, again, that trade-off between, do I want a little bit more risk and get the little bit more commensurate yield, or am I more comfortable staying with more of an investment grade?
And are we talking junk bonds here?
We're talking bonds that... Yeah, high yield bonds. Yeah, in fact, there's one that trades in the U.S. that calls itself junk. So yeah, that would probably make sense.
And the fees, if I recall, on these two funds were 30 and 60 basis points. The higher fee being for the more speculative.
Exactly.
One.
Exactly.
And the reason for currency, because when you announced the equity ETFs, they were not currency hedged. Yet when you come to bonds, you do get currency hedged. Why so?
Yeah, it's interesting, and I think one of the conversations people have to do is understand when you're looking at an emerging markets, exposure, currency is a component of that return. And one of the things that the volatility in emerging markets lends itself to having a non-hedged, but yet when it comes to the risk management component of a U.S. fixed income piece, people seem to tend to want to lean towards, let's hedge that out of there. And so we heard very loud and clear from clients that that's how they wanted those two constructed.
Well, we're out of time. Thank you very much, Heather Pelant, the head of iShares Canada, a unit of BlackRock. And we're going to go back to Oliver McMahon to wrap this up.